So, Mr. Apple Dapple here reached all-time highs today. Obviously, has fallen down quite a bit, but intraday all-time highs were reached at $355.40. So, it's an all-time high for the stock. Definitely a big deal going on. So, the question of today is going to be, is it worth buying Apple at these levels, or really what's fair for Apple at these points? So we're going to first talk about valuation, how that plays into this factor. Then we'll talk about really just the basics of the company and what it has to offer. So I did want to start off by really bringing up, let's look at the numbers, right? Company trading at a market cap of $1.47 trillion. That's right, nearly $1.5 trillion market cap on this company. Trailing PE of 26.49 and forward PE of 22.5. Okay. Price to expected growth of 1.88. Price to sales of 5.6. Not beautiful, and price to book of 18.72. And if you look historically, these are very high valuations, and I think that goes without saying. This isn't even looking too far back. So what I want to do, obviously, is, look historically at PE ratios, because I think that's really important to look at for companies. So this is a company right now trading at 26.5, and if you look historically at PE ratios, this is a chart that shows the stock price, EPS, and PE ratios. We're at very high points for this as far as PE ratios are concerned, and it's, potentially concerning stuff here. Back in 2007, before the financial crisis, PE ratios reached points of 38. But on average, over the past 20 years, really, this stock trades somewhere around a PE ratio of, to be fair, maybe 16, 17. So usually that's pretty fair valuation for the entire market, actually. And Apple typically is one of the leaders in the market, right? This is the stock that everyone looks up to. So that valuation is pretty important. So if you look historically, you might think there's not a chance the stock's worth paying for right now. I mean, this is a P ratio that is historically high. 27 is what that's... Oh my gosh, it's historically high, right? It's the highest level of P ratio that we've seen, I gotta be honest, since 2007 is the highest P ratio that you have seen for this stock since 2007, 2008. So these levels are very high for this. The valuation's very high. So the question is, during this period, I like to look at the revenue for this company, right? I want to see what happened during this period, and was their revenue shooting up? Is that why, is it different from now? So if you look at now's expectations, we're expecting a 1.2% increase in sales this year. This year's kind of a wash, I got to be fair. With everything going on, it's hard to really say that this year should be a growth. Next year expected 12.4% growth, right? So let's look historically and see if this 12% growth used to exist, right? If we look at the revenue of this company historically, so in the same time in which this company, which let's go back here and let's look at this P ratio, in this 2013, 2012, 2014 range, right, when it was trading historically around the 13s, 14s as far as PE ratio is concerned. You look at this company, and it was growing revenue upwards of 10% consistently. In 2014, consistently growing 20% in terms of revenue. Yet the PE ratio was still cheap. It was still in the 14s, right? This is very cheap valuation. But now the company, which has shown very little growth, obviously a part of it is the law of large numbers. It's hard to grow when you're seeing revenue so high. It's hard to grow that 10-something%. But now we're expecting, this is crazy. We're seeing single-digit growth, yet the P ratio is at all-time highs, which is crazy. It is crazy. Single-digit growth. Even in 2007, at least this thing was growing 40%. Right now, we're growing 1% this year, potentially. And we're talking about a P ratio that is near its highs. It is at near its highs from 2007, in which it was growing revenue 40%. So, is there justification for this valuation? I'd like to compare it right now to a different stock, a similar one in the tech industry. We look about Facebook, right? So, if we're basing this off stock price, year to date, Apple is up 17%. And if you look 5 years out, Apple is up 177. Really, I'd like to look more at this year range, right? This year range is pretty important. 1 year out, up 77%. And let's be fair, this stock's up 77% in a year in which its revenue really only saw a growth of, 10% at best. Most likely you're looking at 5 to 6%. Facebook, on the other hand, in the past year has grown its share price 25% only. 25% only. But this is a stock that in the same time, if you look at the financials of this company, trading at a P ratio of 31, by the way, 31, pretty fair. Price to PEG ratio, cheap, cheaper than Apple's, and price to book, cheaper than Apple's as well. But if you look historically in terms of revenue, this is a stock that really, in this last year from 2018 to 2019, which is kind of what we're basing this off of, grew their revenue significantly from $55 billion to $70 billion in a year. And that only warranted a 25% jump in the stock. 25% versus Apple's 5 to 6% growth, warranting 77% growth, right? 77% jump in the stock. If we're looking simply based off these numbers, a lot of people might think it's insane to consider investing in Apple right now. But you look, and you don't mind the typos, right? You don't mind the typos. But if I just go on Seeking Alpha here, you know what I see? I see nothing but price target raises here. Get that out of here, you pop-up ads. Apple price target raised to $390. I mean, these are everywhere. Street analysts are raising this like no one else. Citi, street high price target of $400 here. Okay, pop-up ads, you're doing dirty. $400 price target on this one. That was yesterday, right? Every single day we're having an analyst say, that's right, Apple looking good. We're going to keep on really just upgrading this thing, right? Apple price target raised on the 11th to $390. Wow. Bank of America raising it. You look on Seeking Alpha, and analysts are raising this price target like no one's business. So they're talking about still significant more growth to go beyond this. And we're talking at a time in which PEs are going to be going over 30 because of their really, price targets. Your PE ratio is going to be pretty high, right? Potentially in the 30s. Now, it could obviously not be that high. It all depends on what that EPS number looks like, and they've been doing good at cutting costs, obviously. Very smart company. Because the company's got a lot to offer. So why is it potential that this stock has this valuation? Well, you think about what it has to offer right now, and when you think of Apple, obviously you think of their biggest segment in iPhones. And then you think about, obviously, the Apple iPhone 12 that is expected to come. And obviously when we see this, we talk about the 5G quote-unquote super cycle potential. This next generation of iPhones will be 5G enabled, and if it's anything like what 4G was able to do, right? If it's anything like what 4G was able to do, 4G coming out in 2010, you see really the growth here from 2010 onward was pretty big, right? They grew sales pretty steadily because of a quote-unquote super cycle. So is this potentially going to be what breaks it, right? Look at these units of iPhone sales, right? 2008, 2009, and then you go into 2010 here when we talk about 4G. They doubled their iPhone business from 2009 to 2010 when we talk about 4G. And after that, just continued growth. And it's kind of died down since then, right? It's died down in terms of growth numbers. And that's because there's not been the big wow factor, right? We talk about a weak 2018 with the iPhone X and XR 10, whatever you want to say. Okay, I'm calling them X's. Just a weak cycle. The iPhone 11 doing a lot better, but is there going to be a massive upgrade push is really the question. And maybe that's why this valuation is the way it is. Maybe investors are expecting a massive growth in that. But you got to think about the fact that, well, Apple's not just these iPhones, right? It's not just these iPhones that are going to be coming out this year. Potentially early next year, really, depending on supply chain. Apple's not just these iPhones. Obviously, you think a lot about it. Apple's not just the iPhones, man. They've got the iPad. That's right. We go into all their segments. The MacBook, man. Can you believe it? MacBooks. Not a segment that's expected major growth, actually, and it hasn't been showing growth. iPads, not been showing that much growth either. So the hype really isn't about the MacBooks or iPads. Where's it at? I mean, the Apple Watch certainly is part of that hype, right? We talk about the number one wearables company right now, and really, in the future, still going to be the number one wearables. This company has a lot to offer in terms of wearables, and obviously the Apple Watch is going to be consistently the number one in terms of this, because it's very good technology. It's quality technology, and people know it's a trustworthy brand. They make good products. What can I say? So wearables is a market that continues to grow. Wearables continues to grow, and as more and more people are getting really Apple Watches or smartwatches in general. So they have a good potential ahead of them there. We look at, well, what is unarguably the biggest potential for them possible. And it's going to be services. You see it in Apple TV Plus. That's right, another streaming service out there. Apple TV Plus is going to be massive. They have many, not really many a series right now, but they're working on just increasing that in terms of series. So people are definitely getting in on that. The numbers are going to be massive, but I don't think investors realize a majority of those numbers are coming from people who are getting the service for free. If you upgrade the iPhone, if you join Verizon, there's so many promotions that give people Apple TV Plus for free. But services might be why this valuation is rising, because this company is going back into a higher growth state because of the services. We also have Apple Arcade, right? We talk about gaming being massive right now. Gaming's being massive. And with Apple Arcade having a small, albeit small, segment of that, it's a big benefit for them, right? It's a big benefit for them. You have Apple TV, Apple Arcade, Apple Music. Obviously, it speaks for itself. You see the growth in really all streaming of music. Apple Music just sticks for itself, right? Obviously, with them, you've got Beats, AirPods. AirPods are just ridiculously massive, even in the wearables market. AirPods are the number one wireless headphones, and they consistently will be. There's no doubt about that. AirPods Pro, which is a new release too, by the way. There's just a lot going for this company, and I think that's potentially why this valuation is that way. Now, for me, what do I think? I don't think this valuation is quite fair. From my perspective, I think the stock should be sitting right at $300. I think $300 is a point where I like the stock. At $350, I really don't. I'm already up over 100% on my position right now. 100% on my Apple position. I bought my shares at $150. $150, right? You have to go back here to 2017 when I purchased my shares, right? 2017 when I bought my shares for $150. I mean, that's a long time ago, right? This valuation of $300 just seems absurd to me. I mean, this 77% growth, really since 2019, the start of 2019, up 137%. It is ridiculous to see that kind of growth for a company that isn't showing that growth in revenue. I love this company, and they are definitely one of the best companies in the world. No doubt, potentially the best company in the world. But the valuation is just too expensive. Too expensive, right? company's good. I just don't think you want to buy in at these levels. I don't think you do, because I think you could be in for a decent downward move or really stagnant stock movement. I mean, this I don't know where there's more room to grow from here, and I think hopefully it'll fall down. But yeah, that's my opinion on the matter, and I do hope you enjoyed.